Good afternoon, ladies and gentlemen. Thank you all for joining us today for today's webinar on the updated EPRA BPR guidelines and BPR survey scoring methodology, What's New? My name is Hassan Sabir, and I'm the Finance and ESG Director here at EPRA. It is my pleasure to welcome a diverse audience dedicated to advancing transparency and best practices within our industry, particularly on non-GAAP financial reporting. The EPRA best practices recommendation have long served as a cornerstone for enhancing the consistency, comparability, and transparency of non-GAAP financial reporting among listed real estate companies. Today's session will focus on key updates and revisions that ensure our standards continue to align with evolving market needs and market practices. I'm pleased to introduce our speakers who bring expertise and insight to today's discussion. Simon Robson-Brown, who is the Managing Director at Morgan Stanley, and Baris Sari, my colleague in the Reporting and Accounting Department at EPRA. Together, they will guide us through the updates to the guidelines, specifically changes to the EPRA earnings metric and the rationale behind these revisions, as well as the newly revised scoring methodology for the BPR survey. We will also explore what these changes mean for your reporting processes, offering practical insights and addressing key questions to help you navigate and implement these updates effectively. Without further ado, let's get started. Simon, the virtual floor is yours.
Hassan, thank you very much indeed. Good afternoon, everyone, and thank you for joining the call. So my name's Simon Robson-Brown. I'm a portfolio manager at Morgan Stanley. I have been looking at listed pan-European real estate for 25 years. So I've looked at an awful lot of reporting accounts over the years. And I have really valued the discipline and the clarity that the EPRA BPR have brought, particularly when IFRS first came in and there were changes and all these non-cash items coming through. It's been a real benefit, I think, to have all the EPRA BPR. There's been some changes in the BPR over time. We've had things added to it. We've had the LTV was the most recent one. There's the CapEx. There were the adjustments to the NTA. So things are evolving over time. And something that I found was in the last couple of years, the EPRA earnings, the EPRA EPS, was sort of lagging behind the rest of the metrics. And there were two things that really sort of caught my eye. The first was quite mechanical in that the EPRA the EPRA EPS wasn't taking into account the capital stack correctly. And I'm talking the likes of preference shares and hybrids. The LTV metric was using those, and the NTA was adjusting for those, but the EPRA EPS was not adjusting. So there was as the BPR evolved, the EPRA numbers were not being treated on a like-for-like basis between the income statement and the balance sheet. So we were having to make adjustments for that. The second thing that we were finding was that the rules about what could be adjusted from your IFRS earnings to the EPRA earnings was quite prescriptive. And an increasing number of companies were making their own adjustments to get to company adjusted EPS, which sort of felt a bit odd. Felt like if it needs to be adjusted, there's probably something a bit wrong with the underlying number in the first place. The other problem was that some items, because they weren't part of the prescriptive rules, were being left in the earnings EPS, which perhaps shouldn't have been because they were non-recurring. So we were also getting instances of where the EPRA EPS was not being adjusted, where perhaps it should have been. So we had sort of issues both ways. So over the last year, a committee has been formed to see how we can move forward with the EPRA EPS and improve it. And there's been a lot of backwards and forwards, but I think we've got there now. And Barris is going to take over and talk about the ins and outs of that. What I would say, though, is that if you join this call with some sort of trepidation, please don't have trepidation. That we're not going to suddenly have 3 earnings per share. This is not a revolution at all. In my opinion, it's just a refinement and an improvement, and it's making it a little bit more subjective. It's putting a little bit back on the finance functions in the companies to determine what you think is recurring or not recurring. So with that, I'll hand over to Barris. Thank you.
Thank you, Simon. Thank you, Hassan, and welcome everyone. Before going through the adjustment in the main course of this webinar, I think it's important to give a little bit of background, and here's a slide on how we proceed to get to the final guidelines. So first of all, at EPRA, we have, as you know, different departments, and every department has its own committee. Every committee is a group of individuals that will go through any topics that can affect or impact the market or here our membership. And for the reporting and accounting committee, this group is composed of investors such as Simon, property companies, Big Four, and also Nareed and RealPac, which are EPRA counterparts in the US and in Canada. We also discuss internal projects and such as the BPRs. We go through the results, the performance of the year, but also we make sure to keep them relevant over the years. And recently, the idea of updating the EPRA earnings, as Simon mentioned, was on the table. And to do that, we created a subcommittee, which is a smaller group of individuals also composed from the RNA committee. So we had different meetings starting in November last year. As you can see on the slide also, we had a second one in December and one in March. And during those meetings, we discussed thoroughly all the adjustments and what we wanted to do with this update. In between these meetings, we also circulated different drafts. Just as a fun fact, I think we had 26 versions of the draft, so it gives you an idea on how serious every individual took their mission in trying to update the earnings. Finally, the final draft was circulated in June. And after back and forth regarding formatting and refining the wording, the last and final product was released on the 1st of October. On the next slide, this is an extract of the guidelines, which are in the resource tabs of this webinar, so you can click and download them directly, which I'm sure you already did. And this is the same for the methodology, as we can discuss it later. So as you see on the screen, what we did is added 2 sets of adjustments. The first one related to the funding structure, and the second one to non-operating and exceptional items. Here on the slides, again, is a snapshot of the guidelines. So you see the first set of adjustments are the hybrids and preferred shares, D-shared, and preferred equity. So regarding the hybrid interest, the interest payment related to hybrid securities must be deducted from the BPR. And the rationale here was to mirror also, as Simon mentioned, what we're already doing on the different BPRs. Meaning, for example, on the LTV, we treat hybrids as debt until we convert them to equity. So we thought it was important to remain consistent throughout the whole finance metrics. On the second adjustment, all form of compensation paid to holders of the preferred shares, D-shared, and preferred equity have to be deducted from the EPRA earnings. So here I'm going through all the adjustments, and of course we can discuss about any questions you will have. We'll have a section for that right after. The second set of adjustments are related to the non-operating and exceptional items. So the first one, unusual items, are referring to those that are unusual in nature and very unlikely to reoccur in the foreseeable future. You will see below a list that I would like to precise is non-exhaustive. These items have been directly taken from annual report that we ran through on the past years. So they are very specific to 1 year of a specific company. So they might not be applicable to you, but we thought it was important to highlight what type of unusual items we were referring to here. Another important note here on this adjustment, a note will have to be also disclosed beside the EPRA earnings to explain what is composed as part of the unusual items, as you may have different item considered unusual, maybe really significant surrender premium and then some gain on any pension buybacks, and you will have to put everything in one amount and then disclose them in a table below. The second adjustment, the foreign transactions cost has to be deducted. It's important to note that here we are referring to non-operating foreign exchange transaction cost. Then we have the contingent consideration. So the changes in fair value of those have to be eliminated from the EPRA earnings as well. This will ensure that the EPRA EPS reflects operational activities of the company. Then we have also impairment of equity interests that have to be reversing from the EPRA earnings. The adjustment E, depreciation and amortization on non-real estate investments. So the first sentence exclude depreciation and amortization of non-real estate investments that are fair valued based on the revaluation model in accordance of IAS 16 tangible fixed assets. So again, as you can see, it's very specific. So what does it mean here? We mainly refer to solar panels. So the first year of investment, such as any other investment, it will be recorded at cost. So here there is no question. You just have to strip out the depreciation. But then the second year or any subsequent year under IAS 16, you can opt for the revaluation model. In this case, the asset will be carried at a revalued amount, which is the fair value at that date, net less any depreciation. And this is the amount we want to take out from the EPS as well. And finally, IFRS 5, where the operating income of an asset that is held for sale is offset against the profit and loss on sale. It should be included in the EPRA earnings. In this case, it means that if we go back to the first slide, the slide just before, as part of adjustment 2, the profit and loss relating to operating income until disposal, in this case, will have to be reversed as part of the new adjustments. Yes, so now we have a set of questions and answers that I will go through. In the meantime, you can already think about the question you have, and we will take them into account after those. But the first one we already received since the release of the guidelines is when will it be effective? So the guidelines will be effective for the next reporting period starting the publication of the guidelines. So what it means is, as most of property companies, most of our members have December year end, the next reporting period will be December 2025, and therefore will be for the 2026 BPR assessment with Deloitte. And for companies that have, for example, a September or March year end, as you can see in the table, that will be for the next reporting period, so September 2026 or March 2026. That being said, as you can see also on the table, we have a line applicability and mandatory applicability. So the mandatory applicability is the one I just talked about, the one that is important for Deloitte as well. But the first one is it's already now. So if we encourage already companies to disclose the BPRs in line with the new guidelines already this year and the next quarterly reports. Because as we already discussed, these are just two new adjustments and not applicable for most of our members. So if you can already disclose the new guideline, that would be perfect. Next question. We also, apart from these two adjustments, updated the guideline at certain levels. So what has changed on the EPS calculation? We realized sometimes that company didn't use the average number of shares, and we wanted to make sure that it was the requirement. So this is what we updated in the guidelines. Regarding the surrender premiums, we understand that in the guidelines, it says significant and unusual, and sometimes it may not be really precise, but we want to here focus on the frequency and how unusual for your company that surrender premium can be. I think it's important here to make the differentiation. And finally, what is considered unusual as part of the last adjustment, we've just discussed about it. The important point that differs from the other adjustment here is that we really want to have a breakdown below explaining what is composed of that adjustment. So the different transaction and the amount that will help any FS reader to have any idea of what is hiding behind this adjustment. So I think I'm going to pause here to answer any of your questions before going through the scoring methodology. So I have one question that is already answered. Okay, perfect. Second question. Yes, that's correct. So the question is, could you please confirm if basic average number of shares equals to weighted average number of shares? And the answer is yes. So thank you for your question, Doreen. Waiting for some more answer. Please don't hesitate. You can also ask your question afterwards to me or Hassan, and we'll come back to you after the webinar. We have a new question here from Bart. So more in general, can we validate KPIs internally, or do we need an external party to validate? That's a very good question. We don't have specific requirement regarding the quality assurance you have for your KPIs, but we strongly encourage to do so. Some of our members included as part of the audit work, and it seems like maybe the first year needs a little bit of work to explain what is the EPRA earnings, even though we believe that now it's well known on the market. But over the years, it seems to be a great asset. And I think Simon can confirm that investors really appreciate when they see that the BPRs have been looked at and examined thoroughly by auditors as well. So it's not a requirement, but we strongly encourage you to do that. Okay. Maybe wait another minute for some more questions. And in the meantime, I think we can already jump on the second part of the webinar, which is related to the scoring methodology. And before maybe, Simon, I wanted to ask you if you wanted to jump on anything I said, if I said something wrong. Oh,
No, you didn't say anything wrong. I thought I might just give a couple of examples of the sort of things that were being left in EPRA EPS, which didn't make a lot of sense to me. Just to give you a slight flavor and stuff that we were adjusting out to get to what we thought was the proper operating number. And one example would be a company, it was a non-REIT, so it paid tax. There was a one-off change to the base valuation of an asset. An historical document was found, it changed the base valuation, therefore the deferred tax liability changed, and there was a release of deferred tax. And that was left in the EPRA EPS, which, you know, it made a material change to the number in that year, and then the material downtick again the next year, which not sure that really helped any users of the account. So that would be one example. Another could be, we've mentioned surrender premiums, big non-recurring surrender premiums. Maybe other stuff like joint venture performance fees, which are based on capital returns. That could be something else which could be reversed out. So I just use those as sort of three examples of the sort of thing that as a user of the accounts, we were coming up against and were therefore adjusting. I'm sure there's some more examples which are more marginal. But anyway, I thought I would just flesh that out. Thanks, Barris.
Thank you for your comment. It's important to note that there might be in the future different adjustment that we didn't think about now, because the world is evolving and especially the real estate market. But the driving line to keep in mind is that we want to keep the EPS a recurring and operating income metric. And I think it's important to note that. I see there is no more questions, so I think we can go on the second topic of the day. Yes. So another update during the year is how we will assess companies together with Deloitte. So we didn't change much, but the first thing we did is as part of the requirement to be a silver award member, it used to be you have to score minimum 60% and disclose 3 different BPRs. And we decided to change it to 60% and 5 BPRs. So it's a little bit stricter, but we thought it was making more sense. The second item, it's just a change of name, so there is nothing to worry here. But we decided to put the like-for-like rental growth and the CapEx disclosure in the same bracket as the other BPRs. Before, these two elements were in a different chapter, a little bit hidden, and we received a lot of questions about them. In order to make it clearer, we just wanted to add them back in the list. So nothing is changing here in terms of like assessment. They keep the same weight of score, and we keep assessing them. So just a change of name. There is also the EPRA LTV that we added back to the mix, which is a new BPR that has been added after the last scoring methodology. So it just made sense that we added back. And finally, the zero line item policy. So this is for companies for which, if I take an example, the EPRA LTV, you have a huge table with 10 to 15 adjustments. And for your company, only 3 or 4 of these adjustments will be applicable. Before, and we needed the whole table with all the lines, even with 0, to be disclosed. And we decided to change that and to make it clearer, keep only the table with the adjustments that are applicable for your company. So on the next slide, you will also see the last item we changed is the scoring allocation. The weight doesn't really change as we doubled every BPR points, but we wanted to make it up to 100, as before it was 47.9, which was a weird number. Over the years, we keep adding different questions on the checklist we gave to Deloitte, and we just thought it was better to keep it up to 100. So this is the weight for each BPR. And then the first question that I think is really important, when will they be applicable? as opposed to the EPRA earnings or the guidelines in general, the changes on the methodology will be applicable already for next year. So for the 2025 BPR assessment. Then a second question was relating to the zero scoring policy. We received this question a lot over the past year regarding the EPS and what does it mean for the EPS, this policy. So the zero scoring policy means that you have to disclose the calculation of every BPR to receive score on it. For the EPRA earnings per share, it means just the number of shares. So it's not a big deal, but it still needs to be disclosed. And finally, the last question, I think I actually just went through it during the first slide. But yeah, we decided also because we receive a lot of comments that the annual reports and the financial statement are getting bigger and bigger. So if we can make it more precise and concise at our level, this is what we try to do as well. So here, just remove any zero line item that are not applicable for your company. One thing that is important is that you please explain below why you remove those items, because they're not applicable and not because you just decided to hide them. And yeah, I think that's it. I'm waiting for any of your questions on this. Please don't hesitate to also send me or Hassan an email after the webinar. So sometimes it's easier when figures are involved. And yeah, maybe Hassan, I had the floor.
No, thank you, Boris, and thank you, Simon, for your insights and explaining to our audience the update to the EPRA BPR guidelines, in particular the EPRA earnings metric and also the methodology. As Boris mentioned, we have hopefully our contact details. Please do reach out to us if you have any queries. We're here to support you in applying the BPRs. So we're happy to receive any message or emails you have. I do see Nicola, who has raised his hand. So we can't open the webinar for a live interaction. So Nicola, if you would like, could type your question in the chat option or the Q&A option with Zoom. We'll be very happy to respond to that. So maybe let's give it a minute or so.
Maybe I can also let you know that we have a set of already question and answer on the website that you can find if you need more details on anything that we just discussed today.
Okay. Yeah, we can circulate the presentation with all attendees for sure. Thank you, Frank. Okay. Okay. If no other questions, then we can conclude today's webinar. So thank you once again to all attendees for joining. As mentioned a few times, please do get us in touch if something's not clear, if you require any guidance. And I specifically wanted to thanks Simon for taking time out to share his views on the update. Simon has been instrumental in the discussions and guiding us at the EPRA staff and coming across with this update. And thank you, of course, Boris, for the presentation. Thank you, everyone, then, and have a great rest of the day.
Thank you.
Thank you.